Welcome to Creative Insights, the workshop for financial advisors, insurance professionals, and fiduciary consultants. Today's workshop, when should pre-retirees consider non-qualified plans? Part 2 of our 5-part series entitled, The Power of Tax-Free Retirement Income. In this segment, we're talking about prospects and clients and a risk tolerance test for product suitability when it comes to life insurance. And every time I bring this up, this is a new concept to most advisors and insurance professionals because I really need to know which am I going to use. Because there's so many out there, and I want to be able to look at the 4 mortality chassis. The participating whole life, I'm looking at current assumption universal life, index universal life, and variable universal life. Now, keep in mind that even though in index and life, we talk about this a lot, and this is where I've gained a little bit of fame online, most people are saying that you can never lose any money with indexing, but actually, if you didn't credit anything in any one given year with an index life product, you still have expenses to pay in the policy. So you could actually wind up losing money in any one given year. So if my client's risk tolerance doesn't really equate to that, I may have to look at participating whole life just because they're not willing to do that. So I'm looking at 4 different policies when I do my test. And so I want to be able to look at those 4 policies and try to figure out what I should do. Now let's look at that for a second. And let's look at a basic, and you can use your own. I'm just using the one that I use from Backroom Technician, brought to you by Advices. And I've been using this for a long time. It has basic questions that's going to help me understand if the client's a conservative moderate, a moderate aggressive, or an aggressive client. It kind of gets me in the idea, it gives me a game, and it has a battery or a series of questions that will help me kind of get the psychological profile of the client. I really need to understand what's going on here, and then I'm going to look at this and match it up to what he's already doing. Many times I've seen clients who do this test, told me that they answered it honestly. Then I looked out at their portfolio, and their portfolio did not match the results of this test. So I start to wonder, are you really deluding yourself really in the way you're approaching money because your test results from a psychological point of view don't really match up to your portfolio? Now, there's just a few of these. They have different scores to be able to assess it. And again, there's a lot of them out there. I just happen to use this one. And so I'm going to ask questions like, in terms of your experience with stocks and bonds or stock and bond mutual funds, how do you consider yourself as an investor? Are you very experienced, less than average experience very little experience, or no experience? And the client's going to check on that. There's going to be questions, what type of changes have you made in your house, in your investment portfolio in the last 5 years? Have you started to pull in? Are you getting closer to retirement? It's going to walk you through some of these questions. You're going to assume that you owe maybe that you own $500,000 in your portfolio. Then assume that you have an opportunity to make an investment of $20,000 of assets into a portfolio that has the following chances of gains and losses. It's going to walk you down there and saying you're taking a small piece of your portfolio and here's what could happen, and if it did happen, how would you react? That litmus test, that psychological profiling will really help you understand your client's thinking, and it'll walk you through what I call very pragmatic questions. Assume that the same chances in investment of $20,000 are as above. How would you assume the total financial assets are at $200,000? What are your chances that you would select 70% chance of gaining $5,000? What is your measurement? I'm willing to give up maybe 10% loss for a 20% gain. What is the combination? And it'll walk you through your risk preferences, your behavior towards risk. It walks you through basic determination of the appropriate levels of risk. And then finally, it's going to come to a number where I can take my total score from the questionnaire and I can pretty much understand what my psychological profile is for risk and reward. Once I know that, then I can go back and look at my 4 chassis to see which one I want to look at. And I'm going to be, like, for example, I'll give you a perfect example of this. I had a client who marks his entire portfolio to 10-year treasuries. Well, I don't think that's a very good deal, but that's what he does. He's conservative by nature. He'll never see current assumption universal life, index universal life, or variable universal life. He doesn't have the risk. His propensity, his personal profile is way too conservative. So I'm going to have to look at participating whole life. And by the way, a little heads up here. If I'm going to go down participating whole life, I cannot use a term writer because it's based on current company practice and not guarantee on almost all these contracts. And remember, I'm going to be using a paid up addition side fund. That side fund with those dividends are not guaranteed. So if I'm going to be the pure of the pure and I want to show him his guarantees for sure, I'm going to show him a participating whole life contract. And there's about 3 or 4 players in the market right now that are really good for conservative people. And if you're right now, current assumption UL is kind of falling out of favor because of our low interest rate market, which is really why we created the ability to do indexing. So a lot of the products that we have here, these are all great products and they are going to be suitable for certain clients. Once I've done the risk tolerance test, I can kind of look at this and say, what should I do? If I'm with a young man or a very aggressive female or in regards to the kind of investment portfolio or their position or their posture, I could look at variable universal life because it's great for the tax issues and I can still stay heavily involved in the market. Now I can lose money on that, and some people, after hearing the index story versus the variable story, they may very well choose indexing. They'll say the caps are high enough on indexing or I can profit from that. I'm going to still go with that because I don't have the loss position in the crediting. I still have bills to pay. I still could lose on the basis of the policy fee. And remember, everything you're looking at in illustrations is current company practice. There is a whole nother set of rates called guaranteed contractual rates, and the disparity between current company practice and contractual rates, that disparity can be quite big. So anytime I see a contract that has current company practice and guarantees and the actual disparity is very small, I like that and I assign embedded value to that because now what they're saying in the current assumptions are pretty close to their contractual guarantees. I like that because it really helps me understand that the carrier is doing a good job as best they can. Now I want to look at a few things called the S&P for indexing because it's so popular right now, and I just want to make sure we're up to snuff on this. The S&P 500 is the most popular index of all the indices, foreign and domestic, that are chosen today, selected for annuities and life. In life insurance, I'm always looking at the percentage of what the client wants to do. And usually every time I bring up foreign, I might bring up a mix of different, the Hang Seng, the Euro, whatever I bring up, they're so used to the S&P 500 that 72% of the time, that's where they're going, whether it's an annuity or a life insurance contract. Everybody's familiar with the S&P 500. They kind of know what the VIX index is. So the question is, what is the 100% return on the S&P 500 over the last 20 years using 2 20-year tranches that are doing annual point-to-point, and they're doing it every month. They're stopping and starting. So you're going to have about 480 sequences. What is that number? And right now, and I'll show you this in a second, that number is right around 5.5%. So if you're looking at the 100% probability over those 2 20-year tranches, that's the number. But indexing was built to actually, it was designed to perform at 200 basis points over the carrier's UL crediting rate. So if the UL crediting rate's at 3.5, 4, he's really only going to be at another 200 basis points. So I like to show the illustration at the S&P 500, there's the 100%. Then I like to show what the carrier's number would be, 200 basis points over their current interest crediting rate. And then I want to look at the AG49 index universal gross rate. Now the carrier we've been showing here has 7.43%. That's the cap based on the regs, and that's all they can show. So I'll be showing, in this case, I could be showing 7.43, which is the AG49 max cap. I could be showing about 6% based on the 200 basis points over current interest, portfolio interest, and then the third one would be the 100 percentile over the S&P 500. Now, this is a document put out by a carrier, and you'll notice that they give the historical returns of the 1-year point-to-point account using these 2 20-year tranches, and I really like this because it gives the probability ranking over this period. So at 5.5%, that's 100% probability. I just told you that the contract that we just looked at, their AG regs for that one carrier, their maximum they could show on illustration was 7.43. If I look at the difference between 7.5 and 7, right in between that someplace, right around 7.5, that's an 82% probability ranking. So even though the AG49 has knocked down what we can actually illustrate, even with what we call quality backtesting, I'm looking at 82.7% probability rate at this carrier's AG49 maximum rate that they can display. I still think that's pretty good. And then if everybody's different, this carrier has their different maximum rates that they have already published for every product that they have. So whether it's S&P or in this case, they do multiple indices that are foreign and domestic, you can look at those rates and actually plot your strategy based on that. And then I'm going to show you this one idea that I think you're going to find fascinating. I'm looking at this period called the lost decade, from 2000 to 2009. This is 10 years, the worst decade since we've been alive, since the Great Depression, before I was even born. I'm looking at every year, and you'll notice that in 2001, 2002, and 2003, we had 3 straight years of losses. If you were in an index contract, remember, you had no negative crediting to actually experience these losses, but you still had expenses. And if you didn't maximize the contract by lowering the death benefit, you're going to be paying, and I saw many contracts were paying between 9 and probably 950 basis points just to be on that contract. That loss was compounded because they were buying the target premium death benefit, not the minimum TAMR compliant death benefit. And so you'll notice that during this 10-year period in time, my effective yield is going to be about 63.32% over this time period. That's 6.3% actual rate of return in the worst decade. We had 4 loser years, 2001, 2, and 3, and then 2008, we had another bad year. So those 4 years, when you think about it, indexing, but it won't help you to get 6.3 when everybody else is losing if you didn't maximize the contract by making the smallest, by minimizing or designing your contract for the absolute smallest death benefit to keep the cost of insurance down. By the way, if you would have been taking money out during this instead of the accumulation phase, what if you're taking money out? Many people love to do participating loans, but heads up, in a participating loan on a down market, you don't want to be borrowing at 5% or 6% from your carrier. You don't want to be borrowing your own money out. You'll want to be using withdrawals to basis. Remember, you're going to need that in these years where you have defaults. If my client was taking money out during any of these periods in time, those 4 years would have been withdrawals to basis. I'd have never done loans. It'd have been too costly, and it would have taken money off the table for the client. So just remember, whether you're looking at this chart as an accumulation chart or you're looking at this chart as a distribution, just know what you're getting into. This test using this 10-year period is really a great test. And lastly, we came up with a new invention through INSMARC. Now, of course, I've looked at the risk tolerance test again, and I'm showing this again from INSMARC, where I actually helped construct this suite that's now part of the INSMARC software, where you can actually test this out. So I might have a conservative client, a moderate conservative client, moderate, moderately aggressive, or aggressive, and now I have 4 different choices on my mortality chassis on which one to use. And the cool thing about this is it shows them side by side. Now remember, heads up, you have to be licensed to show all 4 because variables involved in this. All you're doing is you have to be fair, you have to use the same exact rate of return and then let the expenses, they are what they are. But I can compare now par whole life to UL, to IUL, to VUL. I can show them all on a platform so I can really measure it out. But remember, before I even get here, many of the times I'm already making judgment calls, or I might be down to 2 calls or 1 call because the actual risk tolerance test really doesn't support anything else but that. But I can look at these numbers all the way out during distribution and get a pretty good idea which chassis is going to work the best. But again, that's all predicated on the client's risk tolerance test. This has been part 2 of our 5-part series entitled The Power of Tax-Free Retirement Income. For more information about the subject matter in this workshop, just email me at ssavant@creativeone.com.